Look at 39 trillion of debt. If the bonds burst, you have to rely on the 8,167 tons. Well, then you have to have about $150,000 an ounce price of gold for that gold to support that 8,167 tons, assuming we have it, to support the treasury system 1-to-1. And 40%, I mean, you're still looking at, I don't know, 40, 50, 60,000 gold. Well, the rest of the world is not going to allow us just to slap an accounting value of that on gold when gold's not trading that high. Now, could it be the gold's ultimately worth that because of all these fiat currencies? Sure. But for the U.S. to just declare and an accounting, a book entry and say, well, we're revaluing gold from $42.22 to $150,000. The rest of the world is going to laugh at you. And it's going to be an admission that the U.S. system is collapsing because that's the only reason you would do it.
The global financial system is teetering on the edge as mounting sovereign debt threatens to dismantle decades of monetary stability. With record unbacked obligations accumulating daily, the traditional fiat treasury framework faces an unprecedented reckoning. Robert Kientz, a respected financial analyst, precious metals researcher, and economic commentator, emphasizes that the United States is navigating an increasingly dangerous fiscal trajectory. Attempting to back $39 trillion in national debt with domestic gold reserves would require gold prices to surge toward $150,000 per ounce. Any artificial accounting revaluation of this magnitude would be viewed internationally as an admission of total currency failure. Furthermore, as 10-year Treasury yields push past critical thresholds, the Federal Reserve will inevitably be forced to raise interest rates. This shift threatens to trigger severe bank liquidity shocks and bond market defaults. Instead of an engineered soft landing, financial indicators point to an aggressive, brutal economic crash as global de-dollarization gathers speed. Now, we present the clips from Rob Kientz's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
The U.S. has 39 trillion of debt. China has 19. China, we think, has between 30 and 50,000 tons of gold, either in state coffers or in the coffers of the people. So if they really needed it to support the currency, they could get the Chinese people to contribute some. I mean, they could confiscate it like the president did in 1933 with an executive order, but more than likely they would just say, hey, it's for the benefit of the country. And Chinese are very loyal to their country, the people. It's a little bit different culture there. But if they have 30 to 50,000 tons, that they could somehow wrangle most of that in supporting an economic system, and we only have 8,000. And even if we have all that 8,000, it's not leased out. It's the same good quality stuff that you trade on the LB-May, the 400-ounce bars. Great, but you still only have a fraction of what China has, and China has only half of our debt. And China's renminbi is rising in terms of valuation, and the infrastructure they're building around the world, people are coalescing around China because they're financing the Silk Road Initiative. They're financing the building of petroleum pipelines in Russia, which is the only way that Russia can sell its oil because of sanctions. So they're building relationships with the Middle East, very strong relationship, not just Iran, but like Tajikistan, all these countries. And China's also building some relationships with Europe. And, I've been watching videos of people explaining trade flows and things on YouTube. There's a lot of really good research on there that's verifiable. And China's really positioning itself as a financial powerhouse at the same time that they're positioning themselves as a military powerhouse, by the way. And, all of that's coinciding at the same time. And China is definitely rising in terms of a world power. Now, they can't project the same force militarily the U.S. can, but their technology is getting better and they're spending a lot of their GDP on it. And what China is doing, however, is using its economic power to build a stronger economic foundation. And I think it's incredibly intelligent the way that they're doing it. I wish the West would go back to doing it. But the consequence is, we already saw bond rates rise, and we might as well pop this in, the bond rates. The 30 and the 20-year U.S. bond rates are above 5%. And the 10-year got to almost 4.7%. Now it's at like 4.602, I think. Those are dangerous. If the 10-year hits 5% and stays there, we have serious issues. More than likely, the Fed would be forced to raise rates because you have to raise rates when your bond rates are rising. And right now, the federal funds rate is way below the bond rate. And with all of that debt and with the financial problems that the U.S. is having, that bond issue is really going to come into play. And if those bonds burst, if you look at 39 trillion of debt, if the bonds burst, you have to rely on the 8,167 tons. Well, then you have to have about $150,000 an ounce price of gold for that gold to support that 8,167 tons, assuming we have it, to support the treasury system 1-to-1. And 40%, I mean, you're still looking at, I don't know, 40, 50, 60,000 gold. The rest of the world is not going to allow us just to slap an accounting value of that on gold when gold's not trading that high. Now, could it be the gold's ultimately worth that because of all these fiat currencies? Sure. But just for the U.S. to just declare and then accounting in a book entry and say, well, we're revaluing gold from $42.22 to $150,000. The rest of the world is going to laugh at you. And it's going to be an admission that the U.S. system is collapsing because that's the only reason you would do it. So, the U.S., what they need to do is to stop overspending, pay down debt, and accumulate more gold like China or Russia. And they're not. It's a very dangerous game we're playing. It is a very, very dangerous game. And I think it's accelerating de-dollarization. And it's kind of like a waterfall. Stuff builds and then you go over the edge and then it's a straight drop down. Or if you look at it the reverse way on a financial chart, a hockey stick where it goes like this. And that's what we're experiencing. We're getting to the point of where the dam breaks, and the water rushes and floods the city sort of situation. I think Chris Martenson years ago had a good illustration of this. If you take a drop of water and fill Candlestick Park in San Francisco, the baseball park, it takes a long time to get to 99%, but then it's like, boom, then you've overflown the park. I mean, that time to get to 99. So if you're outside, you don't see it, right? And it rises, then all of a sudden the water breaks. And that's really what's happening in the financial system. And I don't think it can be stopped. I don't think the numbers work. If you look at research, Rogoff and Reinhardt and all that stuff about debt to GDP levels, the U.S. is not going to, it's going to have some sort of bust. It's really how we handle our finances from here on out that determines whether this is a really soft landing or a really ugly hard landing. And Elijah, the policies of our politicians and the Fed are simply to continue to stick their head in the sand and do more, knowing the danger. And I don't see any sort of soft landing ahead. I see a brutal landing ahead, unfortunately.
A massive geopolitical shift is underway as Eastern economies strengthen their financial and physical foundations. China holds an estimated 30 to 50,000 tons of gold, while maintaining half the debt burden of Western powers. By financing international petroleum pipelines and expanding the Belt and Road Initiative, Beijing is positioning itself as both a military and economic powerhouse. In contrast, Western markets face severe structural vulnerabilities. Spiking bond yields are rapidly eroding bank liquidity, reducing asset face values, and increasing the risk of cascading bank failures. Simultaneously, residential real estate affordability has plunged to all-time lows, signaling a housing bubble far more dangerous than the 2008 financial crisis. As fiat currencies continue losing purchasing power, traditional equities and bonds will fail to cushion deep recessionary shocks, leaving tangible physical assets as the primary defensive resort. Now, let's get back to the interview.
I think we're talking about the main attribute for gold here. The main attribute for gold is to keep up with inflation and provide financial safety. Yes, gold's gone up a tremendous amount in the last couple of years, and it's separated from the CPI. I think I've mentioned this before, definitely on my program, probably on yours. In 2024, about midway through the year, from 2000 to 2024, gold almost mirrored the CPI. Not exactly because you had the big up and downs, but if you look at it on a chart, basically the traders were trading gold to CPI. They were recognizing that gold is an inflation hedge. Great. Not necessarily a crisis hedge. But in 2024, that changed. I think it's being priced as a crisis hedge because gold has accelerated so much faster than CPI. And I think the realization of international traders is that the value of gold must go higher given risk in the system, given currency printing, given inflation, giving all of that stuff. And we have a saying in the stacker community that stack or stack regardless of what the price is. If you're kind of new to this and you're trying to figure this out, I would just say this. If the system breaks, and look, give you an illustration. The second, third, and fourth largest bank failures happened a few years ago in the spring because of bonds. When interest rates go up, let's say interest rates are 5% now, and I bought a bond 2 years ago for 4%. Well, mine's only paying 4%. So if I want to sell that bond, the value of that bond has to come down. The face value goes down. So when interest rates go up, face value comes down. When face value comes down enough, banks start missing liquidity and asset ratios needed to be stable, to meet regulatory and compliance requirements, and to be stable. And investors pull money out, investors first, and then you have people taking money in a bank run, cash out of the bank, which saps the bank's liquidity. Both things sap their liquidity. Then you have bank failures. So bond rates go up, bank failures. Bail-in laws mean that they're probably going to take a lot of your money to pay for it if your money's in one of those banks. So is cash in the bank going to save you? What happens during recessions? Bonds go down in terms of their face value and value to you still get the coupon rate, but if you're in high inflation, it doesn't matter. It's not going to help you. You're going to lose your principal, and you'll lose it very, very quickly. The stock market goes down, and even if the stock market goes up, it never keeps up with inflation during a deep recession. What asset are you going to get into? Are you going to do Bitcoin? Bitcoin's sitting at 60 something, 68, 69, or whatever it is today. People don't seem to be investing in Bitcoin, given world risk. It's quite the same. It's got some issues, okay, which we've talked about before. The only things that tend to do well in the long term during a recessionary or depressionary phase are arable farmland, ranch land, which you can raise animals, gold and silver. Range and farmland actually does slightly better than gold, but it has to be arable and you have to work it. So it requires physical labor. So if you're a farmer and if you have good land, at the end of this next recession, you're probably going to be doing pretty well. But most of us don't have that. And it's much easier to get gold and silver. Now, yes, I realize that gold's expensive at over $4,000 an ounce, and silver's kind of expensive historically when it's, almost 60. But it doesn't matter, to me, it doesn't matter the dollars you put in, because if the dollar's going to be basically worthless and gold and silver are going to capture that value, does it really matter how many fiat dollars you're paying? I mean, it really doesn't. At least you're going to keep up with inflation. And lately, it's been multiples of inflation. The last 25 years in gold and in silver, but to a bigger extent gold, should prove to people that at the very least, gold will save your purchasing power at whatever price you're paying. Because no matter how expensive gold goes, it just keeps going over time. We've had 6 months of a crash, and that's okay. Over the long term, it's gone 25 years. And if you look at every major recession and depression, especially the recessions, because we have more of those since the 30s and early 40s. If you look at that gold and silver vault, just the charts are nuts. And so it almost doesn't matter where they start. There was one quote I had a couple months ago on my program. I was looking at when silver corrected 40%. I think there's 5 times that I could see on the chart dating back 50 or so years since the Commodity Act in 74. We basically had free trading silver on the market in the US. And every single time it rebounded back to reach a new all-time high. And gold tends to be the same way. And that's because where else are you going to put your money? We're in a hyper-leveraged, financialized system that keeps getting more and more financialized. We're doubling down to keep the system going. When that breaks, if you look at Exeter's pyramid, all that value that used to sit in the dollar and all the derivatives and even in the housing market and the bond market flows all down to what? Gold and silver. And Exeter was a central banker of another country, I believe it was over in Europe, and he advised Paul Volcker during our last inflation crisis. He was a central banker that said that during that the ultimate value resides in gold, especially in silver, and not in fiat currency and all of these investment types. So, I don't know that I care what the dollar price of gold or silver is. I just know that it's better to put my savings in that than anywhere else. And so the price to me becomes irrelevant, because where else am I going to put it? You may get less ounces, but that ounce is going to be worth more. So at the end of the day, you're going to be all right. So that's my encouragement to people thinking about gold and silver. Just go look at the last 25 years at a gold chart. Compare it to inflation in the stock market and bond returns and all that. And tell me what does better. And then compare it during times of recession and tell me what does better. It's gold and silver every single time without exception. It just is what it is. And when you see China and the rest of the world just flooding in with reckless abandon into these physical gold and silver markets, then, I mean, come on. It is sovereign nations are doing it. Those markets represent 3/4 of the world's GDP when you add in the Dubai market, the India market, the Russia market. Look at what the central banks are doing buying gold. It's a tier 1 asset. Like what, I don't know what else convincing people would need to have. And I just don't worry about the price. Yeah, you kind of want to maximize dollars to ounces, but if you sit there and wait and it goes up, it works against you. The last 6 months have been a good buying period for gold and silver. And people say they're going to go to zero. And I said, none of the facts economically or in the physical trade around the world or in the history during recessions or depressions shows me that gold or silver is going to zero. I think that's a complete farce. And the economic data is screaming that things are getting worse. Leading economic indicators came out last week, negative 0.2. And the main things were private real estate investment and consumers, basically residential real estate is starting to retract as a leading economic indicator. Housing bubble, anyone? And to prove that point, there's a chart out that the affordability index for housing in the United States is at its all-time low, even worse than 2008. And what was 2008 about? It was an overinflated real estate market. Guess what? It's inflated more this time. It's bigger bubble, baby. I just don't see the alternative. I don't know where you're going to go. If you got all your money in your house, I'm so sorry. I really am. If you've got all your money in bonds, I'm sorry. If you've got all your money, antiques, sorry. Maybe you want to diversify a little bit into gold and silver. Take profits. Consider taking profits of some of your other investments and putting some gold and silver in there to balance it out. And again, check with your financial advisor, all that kind of stuff. But just look at the data. There's no other conclusion based on history that I can possibly come to. I couldn't, Elijah, if I tried, manufacture a decent counter argument if I wanted to. If I'd signed up for a debate or a debate class and the teacher said, you must argue the side of fiat currencies and all these other investment classes against gold, I would just quit and say, I can't. What am I going to? There's nothing to suggest that there's anything other than gold and silver to save in during these type of times. There's just not.
Navigating prolonged financial crises requires understanding how asset classes perform when hyper-leveraged monetary systems fracture. During major market contractions, wealth rapidly migrates down the liquidity pyramid, fleeing debt-laden paper instruments in search of absolute security. Conventional investments including equities, treasury bonds, and fiat bank deposits consistently fail to keep pace with inflation during deep recessions, leading to rapid principal erosion. History proves that physical gold, silver, and productive agricultural land are among the few assets capable of preserving purchasing power through systemic revaluations. Current forward-looking economic data is flashing severe warning signs. Leading economic indicators have slipped into negative territory while residential real estate activity retracts, setting up a housing market collapse larger than 2008. Meanwhile, sovereign nations and central banks are quietly acquiring physical precious metals at record rates to insulate themselves from systemic instability. As global debt reaches unpayable extremes, paper currencies face inevitable devaluation. Securing tangible physical reserves remains the most dependable strategy for surviving the upcoming financial transition intact. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.